going on, guys? Welcome back to day 12. Welcome back to the channel. Today we're going to be going over internal versus external liquidity. This is a pretty simple concept. It's really not complicated at all. I'm going to explain it to you, of course, like in the last video, as a way that you can understand without any confusion, and hopefully after this video you guys have a very good understanding of what it is and how you can apply it into your own charts and your own strategies. So without further ado, let's not waste any more time. Let's get straight into this. So internal versus external liquidity. All right, identifying the true targets of this, right? So understanding the difference between internal and external liquidity is key to knowing where price is going to go next, or have a good idea, have some conviction, right? You're never going to know where the market's going to go, okay? So you need to think of internal liquidity as what's inside of a range, right? You're going to have a low and a high, and whatever is inside of that range is going to be internal liquidity, whether that would be a fair value gap, maybe a mitigation block, anything. All that is internal liquidity, okay? So while external liquidity is what lies beyond the obvious targets like the swing highs and swing lows. So recognizing these two concepts can help you anticipate price movements and avoid being caught on the wrong side of the trade. So if you look here, right, just at a normal chart, you can see, okay, we have a swing low down here and we have a swing high up here. Everything inside of this range from that low to that high is internal liquidity. So you'll see we have a swing low here, we have a swing low here, we have a swing low here, so on, right? So everything inside of this range, even these fair value gaps, are internal liquidity. Any outside swing points like this swing low here or this swing high here that created the range is your external liquidity out here and your external liquidity out here as well. So most of the time, if you want to get really good trades that'll have a lot of efficiency behind them, you want to wait for price to either sweep external and you'll take a trade back to internal, or you could wait for price to come back to internal and then take your trade off of that back to external. So it's really internal to external or external to internal, okay? So if you look at it from an internal liquidity perspective, this is liquidity found within the range. Like I said, it's where price bounces around as it accumulates orders. So price, let's say, will come into this range here, right? It accumulates orders, right? I mean, this isn't really the best example because it's outside of the trading hours. But if you look here, right, we have a swing high and a swing low. You'll see we accumulate inside of this range, right? We come back up to equilibrium of this range here into internal liquidity, which then trades where? Back to external liquidity right here. So those are, in my opinion, the best trades that you can take from internal back to external, okay? So external liquidity, again, this is where the big targets are, usually beyond swing highs or swing lows, okay? It's like the end zones in a football game, right? Think of it in that sense. It's where price is headed to grab stop loss orders or trigger new trades, right? And it's the same concept here, the market building up fuel, but it's not the ultimate destination, okay? You want to wait for it to fuel up a little bit, wait for that confirmation, and then take the trade towards that destination or the external liquidity, or internal, depending on how you want to trade it, okay? Don't disregard the trap areas, the trap zones, okay? So internal liquidity often traps traders into thinking price will stay inside that range. Meanwhile, smart money is targeting those external liquidity levels to grab most of the orders and create those bigger moves, okay? So market context is very important as well. Always check if price is in a consolidation, okay? Which usually is inside of internal liquidity, okay? Or trending toward a major high or low, which is the external liquidity, okay? This will guide your expectations for the next move. When it comes to anticipating these moves, when price is in the middle of a range, it's likely accumulating orders, but once it decides to break out, it's hunting for that external liquidity. So you have to be patient and wait for price in order to reach those key levels. And that's exactly what I mean here, right? We create a range, we accumulate inside of the range, we get that sweep, that internal sweep of liquidity right here, boom, and then price decides to trade to the opposite end of that external range, right? So here's all the accumulation, that's your destination, right? You don't want to get caught up in this, you don't want to, short this and then boom, get stopped out here, and then, whatever the case may be. Patience is key. You always have to wait for the right moves to happen and take it at the right time, okay? So how do you use this in your trading, okay? I mean, it's pretty much what I said already, but I just want to go over it once more so, I can drill it into your guys' head. So identify the range, which we did here, right? Identify this range, whatever the range may be at the current time that you're trading, okay? Look for those recent highs and lows, the swing highs, swing lows. Prominent. You have to look for those prominent swing highs and swing lows. Those define the boundaries of the internal liquidity, and these are your short-term playing field areas, right? So look at the targets. Where are you looking for? Where are you anticipating price to go to? You have swing highs, swing lows beyond the range. Those are the external liquidity zones, and those are the true goals for price, or the true drawn liquidity, whatever you're looking for, right? So again, wait for the move. Don't get stuck trading inside the range unless you have a clear plan. There are areas in price where you could trade within the range if you're a scalper, but again, you have to be able to identify when the market conditions are not favorable, and really just understand trading in chop conditions it's not good for long-term success, for long-term longevity, right? Spot those targets, okay? Wait for the move. Don't get stuck inside of trading the range. It's not good, trust me. I've been there and I've lost plenty of times trading inside the range while I was learning, okay? Again, after all that is done, you need to look for the confirmation. Once price reaches that external liquidity, watch for signs of rejection or continuation, okay? This helps you decide whether to enter or exit a trade, okay? So to sum it all up, internal liquidity is where price builds up orders, but external liquidity is where the real reaction happens. So by understanding this difference, you can position yourself to trade alongside these big banks, these big institutions, the big players, instead of getting caught inside their traps, being that liquidity and then going in your direction and thinking the market's completely against you, okay? So that's basically what happens here off of this trade, right? So if you look at it from a smaller time frame perspective, right, you can see that we trade into internal liquidity right here. And technically, on a lower time frame, this is an external high, even though it's inside of this range from this swing high to this swing low. So again, price is fractal. You just have to think in terms of discretion and just kind of understand how the market moves. So we get this internal push down into here, right? Price accumulates orders here. We get the manipulation below this low into this key level with this SMT. And then we get a trade up to external, which in this case was equal highs, okay? There are times where, you could get something like this, you wait for the SMT here inside the key level, you long here, right? You long from external, and then you could long back to external as well. But again, if you look at it from a fractal sense, this swing high to this swing low, right? Technically, this move up here is back to internal. But from a lower time frame perspective, this is external because of the range that you're looking at, okay? So like I said, it all comes down to your discretion on how you want to view it. But for the most part, don't always think of, I'm taking this trade from external back to internal, blah, blah, blah. Just watch how price moves, back test, understand the way that you want to trade, whatever works for you. And you could use these ideologies to frame those trades, right? External to internal to external, external to external, or even internal to internal. It really does not matter at the end of the day. Just realize where the range is, find out where price is going to bounce inside of that range, or wait for reaction off of that range inside of it, whatever it is, and then take your trade if there's enough confluences backing your idea, okay? That's really all internal and external is. I don't want to overcomplicate it. I don't want to make it stupid, okay? So that's honestly it, okay? This is going to be a short video. I mean, the last few videos have been pretty short because they're just simple concepts, and again, I don't want to overcomplicate it for you guys. If you enjoyed the video, make sure please go to leave a like and subscribe to my YouTube channel if you haven't already. Again, leave comments down below if you have any questions, if there's any confusion that you may have. Like I said before in the videos, I'll be more than happy to make other videos, getting more in depth on it, maybe clearing any up confusion that you guys may have. But regardless, I'll leave you guys with that. I hope you guys had a great weekend. We're going to come back strong this week again, like we always do. Going to have a killer week. Hopefully Monday gives us some strong price action. And yeah, I'll leave you boys with that, and I hope you guys have a great rest of your day. All right, peace.